Great, and thank you, Linda. And again, my name is Michael Beloff. I'm a financial advisor. My main job on a day-to-day basis is working with families to do their own financial planning and investment management. But I have a specialty working with families with special needs children. I have a 26-year-old son with autism and an intellectual disability here in Connecticut. So I've been through birth to three, through the school district services, and now into adult services. And my son does work and has a part-time job. And so I put this workshop together to help educate families on what happens to your benefits and services if you get a paying job. For those of you who are here last month, we did an introduction into benefits for special needs families. This is kind of an ancillary part two to that because Connecticut is a work-first state for those individuals that can work a little bit, and if they have disabilities, folks are encouraged to do so. But there's often a lot of fear from families as to what can happen to their benefits and services if they do start to work. And so that's the context of this workshop. Linda, could you go on to starts going through the slides? Here we go. Why don't we go to the next slide? As a financial advisor, I am required to have certain disclosures. We're going to be talking about certain legal and tax-related items. This should not be considered legal or tax advice. If you have questions about that, you should speak to your own legal or tax advisors. Let's go on to the next slide. So in thinking about your family member with special needs working, you want to think about what's important as part of this. Is maintaining monetary benefits like SSI or SSDI important? Is maintaining medical benefits like Medicaid or Medicare important? Or is maintaining state services like DDS or the autism or the TBI waiver most important? And so part of what you want to think about as you go through this is what's important for you for your child to maintain or for you to maintain, and at what level. Let's go on to the next slide. So, why work at all? Well, as I mentioned, Connecticut is a work-first state. For those individuals who can work, they are encouraged to do so. On a side note, it is generally less expensive for the state to support someone who is working than to support someone in day services. And so there is some incentive on the state side for that. But working can give an individual a self-empowerment and a sense of accomplishment for a job well done. They can have an increased self-worth knowing that they're doing something that's important. In addition, in general, you end up with more money to support yourself, even though there may be some reduction in some monetary benefits. Generally, you end up with more money to buy things if you work than if you don't work. Let's go on to the next slide. Now, it's important to understand Social Security's definition of disability. When you turn 18, the definition of what it means to be disabled, according to Social Security, changes. When you're 18 or older, you're only disabled for Social Security purposes and also for Husky C purposes if you have a medically determined physical or mental impairment which results in the inability to engage in substantial gainful activity. Substantial gainful activity is Social Security speak for working, and it's measured as a bar. In 2024, substantial gainful activity is the ability to earn over $1,550 a month. That is how Social Security is gauging whether someone is disabled under Social Security rules. You should know that that number changes from year to year with inflation. And in 2015, that is going up $70. And so starting January 1, the bar for whether you're disabled or not is the ability to earn over $1,620. Let's go on to the next page. So we're going to be talking about how working affects these 6 benefits: SSI, Medicaid, SNAP, affordable housing, SSDI, and Medicare. And then at the end, we'll be talking about strategies for working while on benefits to help minimize the effects to allow individuals to work more. Let's go on to the next slide. So we're going to start with the effect of working on supplemental security income. Let's go to the next slide. So here is a reminder. Again, we went into a much larger discussion last month, but SSI is a federally funded income supplement program. While it's administered by Social Security, it is not funded from your FICA taxes. It is funded from the general revenues of Social Security. So again, those who are worried that Social Security is going under, the Social Security Trust Fund does not impact the payment of SSI. It's generally designed to help the aged, blind, and disabled who have little or no income and resources. And it's meant to provide resources for basic needs for food and shelter. The maximum SSI in 2024 is $943 a month. That is going up to $967 in January. And as a reminder, SSI has very strict asset and income limitations. On an asset level, you have to have less than $2,000 at the end of any month to get SSI the following month. And SSI is reduced when there's either earned or unearned income. And in many states, although not Connecticut, Medicaid eligibility is tied to receiving at least $1 of SSI. Where Connecticut, we have separate rules for that. Let's go on to the next page. So what happens? How does income impact Social Security? Well, there is a $20 general exemption that can be on every month that can either be earned or unearned. And then there is a second $65 earned income exemption. That means if no one is giving your child money, which would count as unearned income, then they can earn $85 in a month before their SSI is impacted. Now that $85 has not been changed since the 80s. This is one of the few numbers along with the $2,000 asset limit for SSI that has not been tied to inflation and has remained flat for a very, very long time. After the exemption, how does income affect SSI? Well, if there's unearned income, SSI is reduced dollar for dollar after the exemption. But you're penalized less for earned income. And so earned income only reduces SSI by 50 cents on the dollar. How does that work? Well, imagine your child earned $385 in a month. They get to keep the first $85 if there's no unearned income, and the remaining $300 would reduce their SSI by $150. But they're still ending up with more money, and I have a different example in the next slide. We're not there yet. Keep in mind, if your child starts a job, you are required to notify Social Security within 30 days so that they know that they have a job, and you should do that in writing. Then when your child works, all the income must be reported to Social Security by the 10th the following month. So if they work in December, you have to report the income by January 10th to Social Security. And any reduction is reflected in the February payment. So basically, work in 1 month affects SSI 2 months later. And if SSI reduces 0 in a month, again, Medicaid may be jeopardized. Let's go on to the next slide. So here is a more enhanced example of working. Let's say Jane is receiving the full $943 of SSI, so there's no reduction for not charging your child rent. And let's say her wages in January are $931. By the way, you don't have to make this calculation. Social Security will make it for you. So add that 931, you subtract $85, that leaves $846. You divide that by half, and that 423 is what her SSI will be reduced by. Her March payment will be $520. But even though her SSI was reduced, she still ends up with more money. So instead of getting just her SSI of 943, she has her wages of 931 plus a reduced SSI of $520. So she ends up with $1,450, or a little bit more than $500 more, a little bit more than $500 more than she would have had if she did not work. Let's go on to the next slide. So I have some more examples. We're going to skip these. They're a little bit more too complicated into, but let's go on to the next slide. So a couple of things about income reporting. As I mentioned, earned income is required to be reported to Social Security by the 10th of the following month. For SSI purposes, and this is different for other benefits, for SSI purposes, income in December is income paid in December. Essentially, if your child gets a paycheck in December, that counts as December income, even if the money was earned in November. So let's say there's a pay period on December 5th, and your child gets paid every 2 weeks, and that's payment for November 20th through December 5th. Some of that December 5th payment is for November work, but for SSI purposes, that entire paycheck counts as December income. Now, there are several ways to report income to Social Security. There you can call or write your local Social Security office. There is an SSI telephone wage reporting number that's listed there. There is an SSI mobile wage reporting smartphone app. And as the representative payee, you can report the income on the My Social Security website. I often get a question, which is the best method for reporting income? And the answer is, it depends. I would reach out when you notify Social Security that your child is going to start working. I would ask your local Social Security office how they prefer the wages to be reported. And by the way, these are gross wages. This is the money before the taxes and Social Security are taken out. That's what they're going to count. When I asked my local Social Security office here in Stamford, I was told to fax in my son's pay stubs every month because that's how they wanted it to report it. So that's what I do. But your office may ask for something else. You should also know that besides notifying Social Security that your child is working, you also have a requirement to notify the Department of Social Services, DSS, that your child is working. The easiest way to do that is to log on to the connect.ct.gov website, your login for DSS, and update the information on site. Unlike Social Security, DSS does not require you to report income every single month. They just ask you to estimate how much your child is earning on a monthly basis to be used in certain calculations. Finally, one secret that I've discovered is that both Social Security and the Department of Social Security want to be notified in writing when your child starts a job and when they stop a job. In addition, Social Security and DSS will ask for a letter from the employer stating what was your child's last day of working and why they left the job. They need that to prove that your child has stopped working. Let's go on to the next slide. So that covered what happens when you work with SSI. Folks can feel free to put questions in the chat. We may leave the questions to the end, but that's probably the best way. As you have questions, type them in there and we'll go through all the questions at the end. Now we're going to talk about the effect of working on Medicaid, specifically Husky C. Let's go on to the next slide. So, as a reminder of the basics of Medicaid, Medicaid is a jointly funded federal and state health insurance program for low-income and financially needy people, targeting specifically children, the aged, blind, and disabled, and other people eligible to receive federally assisted income payments like SSI. It's administered by the state Medicaid agency, and here in Connecticut, that's the Department of Social Services, DSS. Traditionally, Medicaid has provided two things. It's provided a healthcare program, and it's provided the funding stream for Medicaid waiver services and supports. Traditionally, Medicaid provided institutional care for the aged, blind, and disabled, think Southbury or a nursing home. But in recent years, there have been Medicaid waiver programs where Medicaid waives the requirements for services to be delivered in an institutional setting. And most of the DDS waivers, as well as the autism waiver, are in the community and are part of that program. Typically, you are not going to get any state services through DDS, the traumatic brain injury waiver, or the autism waiver, unless you are on Medicaid. And specifically in Connecticut, we call that traditional Medicaid Husky C, as in Charlie. As a reminder, we have 4 flavors of Medicaid in Connecticut. A and B are for low-income children. Husky D, as in David, is for low-income adults who don't have children. And Husky C, as in Charlie, is the important one for our population. That's traditional Medicaid that provides funding for Medicaid waiver supports. Let's go on to the next slide. So in some ways, this is where Medicaid gets a little wonky. There is here in Connecticut, there are no, how much income you can make and still receive Medicaid services depends on either A, are you on a Medicaid waiver program or not, and perhaps which Medicaid waiver service you may be on. So unlike the published numbers for many of these other benefits, it's a little murky how much you can earn and how much income you can have and still maintain Medicaid. Luckily, there's an answer for that. And the answer for that is something called a Medicaid buy-in program for working people with disabilities, which is available in 40 states, including Connecticut, which, depending on the state, may allow earned income up to $75,000 and assets above $2,000. Now, remember, in Connecticut, in general for Husky C, you can only have $1,600 in countable resources. But under this Medicaid buy-in program, you can have more income and perhaps more assets depending on the state and keep your Medicaid-based services. Let's go on to the next slide to talk about Medicaid specifically.
There is a question in the chat asking you if you can talk about dual eligibility.
I will, but not yet. So I see the question on dual eligibility, but I'm going to address that towards the end. I want to stick with Medicaid for a moment. So here in Connecticut, our Medicaid buy-in program is called MedConnect. And MedConnect is a special Medicaid program here in Connecticut to allow employees with disabilities to keep their Husky C and Husky C services. As of this year, and these numbers have not changed for a while, if you work, you can switch your Husky C to MedConnect. And that allows for two separate things. It allows you to have income, both unearned income through SSI and SSDI and your work income, be up to $75,000 and still keep your DDS or autism waiver services. In addition, if your child gets switched to MedConnect, their accountable resources for Husky C goes from $1,600 to $10,000, which helps you, which helps manage your child's resources. Now, in general, what I've found is, as many of you know, having discussions with DSS to discuss Medicaid can be very challenging because they don't answer the phone. My understanding is that if eventually DSS will move your child from Husky C to MedConnect if they see there is going to be a problem with their income. But you can also choose to apply for it on your own once your child starts working. And by the way, on MedConnect, there's a special rule that your child can participate in retirement accounts, 401ks, and those 401k dollars will now not count towards the Husky C numbers. Now, one of the challenges is a lot of these benefits interact. If your child is still receiving some SSI, being on MedConnect doesn't help as much because SSI still has a $2,000 limit. And if the Husky limit goes up to $10,000 and they're on both SSI and Husky C, they still have to keep under the SSI limit of $2,000. But the important thing, in a lot of this goes to how much your child can earn. If your child's making $24,000 or $30,000 a year, they may not need Husky C. They may not need SSI because they're making more money than the $11,000 of SSI would give them. And so you may decide that it's okay to give up SSI if they're making the money through their job. That's going to be an individual decision for each family. Someone did ask, what happens if you make above $75,000? In Connecticut, and we have the highest maximum of the states that I've been able to find, if you make above $75,000, you are no longer eligible to do this Medicaid buy-in. They call it a Medicaid buy-in because at a certain level, say about $30,000 or $40,000 of income, Medicaid itself starts to have a premium payment. And you have to buy into Medicaid in that way, but you can still keep your services. The state feels that once you're able to make above $75,000, you don't need the services supports from Medicaid. And unfortunately, that's just the way things are set up at this time. But you could make $50,000 or $60,000 and still keep your home and community-based services. Someone asked, is there a minimum amount of earned work income to qualify for MedConnect? The answer is yes, but DSS is not publishing how much earned income you have to have in order to qualify for MedConnect. It's nowhere on the website. Technically, it's 40 times the minimum wage. That's a number published by some states, but it's unclear. When I've spoken to the benefits counselors at BRS, and BRS, our Bureau of Rehab Services, does have benefits counselors, they've said any amount of earned income is enough. Now, you can only stay on MedConnect while you're still working. If your child loses their job, or perhaps like my son, all of their part-time jobs, you are allowed to remain on MedConnect for up to a year after your job is lost. If your child is then out of work for more than a year, they will be bumped back down to traditional Medicaid Husky C. And their asset limit would get bumped at their maximum asset limit to continue to get Husky C we bump back down to $1,600. However, if they had participated in a retirement plan through their work, that asset is still an exempt asset for Medicaid purposes, but it wouldn't be for SSI purposes. And again, one of the challenges in doing a workshop like this is I'm trying to present all the different capabilities that might be there. Your child would not be accessing all of these. And it's going to be situation by situation how this is going to work for you. But that's Medicaid and how Medicaid is affected. Let's go on to the next slide. So now we're going to talk about SNAP. And I apologize, I know I'm going fast, but there's a lot of information and we're trying to get all of it before people have to leave. I'm willing to stay online at the end and answer questions that folks have as we go through. So what is SNAP? SNAP was formerly called food stamps. And it's a federally funded nutrition program administered by state and local agencies. Unlike SSI and Medicaid, SNAP is primarily a low-income benefit, not a disability benefit. But there are special rules for individuals who are disabled under federal rules, and provides up to, this is an old slide, I apologize, up to $291. Interestingly, unlike other benefits, SNAP goes up on October 1st rather than January 1st. And as of this past October, SNAP went up a whopping $1. And so the maximum SNAP benefit currently is $292. Let's go on to the next slide. So SNAP has different income limits. And essentially, SNAP is meant to provide folks who make under 130% of the federal poverty level, which for 2024 was $14,845. So essentially, if you take 130% of that, SNAP is meant to be provided to individuals who make under $1,580 a month. But since states have options, because it's a state-federal partnership, in Connecticut, you're eligible for perhaps some SNAP if you make under $2,430 a month. Generally, they look at both earned and unearned income to see if you meet that number. But if you're disabled, they use a net income calculation rather than a gross income calculation. So if you're disabled, meaning you're on SSI or Medicaid, Husky C, you get to take certain deductions to see if you're below the net income. So typically for disabled people, you get to deduct a standard deduction of $198, 20% of earned income, unreimbursed medical expenses over $35, and some wacky figure called excess shelter costs, which is cost above 50% of your gross income minus those first three things. And if your income limit is under that $24.30 a month, there's no resource limit. So let's go to the next page and show you an example of how SNAP is calculated. So let's say there's someone who worked, they had $800 of earned income, and because of that earned income, their SSI was reduced to $483.50. So they have total income of $1,283.50. First, you subtract 20% of earned income, that's $160. Then you subtract the standard deduction of $98. This person had $100 of excess medical expenses, so you subtract that, and you come up with $825.50. You take half of that. This person's paying $600 a month rent, so you subtract this $412 from that. They have $187 of excess shelter costs, and so this person's, by the calculation, has net monthly income of $638. So the way that SNAP is affected, they feel you should spend 30% of your net income on food. So they're going to reduce this person's SNAP by $191, which is 30% of that $638. And they'll get SNAP of about $100. You don't have to make this calculation. SNAP does it for you based on what you've told them your monthly income is when you report that to DSS. There are some calculators out there to help you figure out, based on your income and your situation, what the SNAP would be. And you might choose to use that if you're not sure if you're receiving, the right SNAP amount. Let's go on to the next slide. So let's talk of effective working on the Housing Choice Voucher Program. Next slide. So what does the Housing Choice Voucher Program, administered by HUD, the Department of Housing and Urban Development, the Housing Voucher Program provides two ways of subsidizing rent from the federal government. There are tenant-based rent reductions, and there are project-based rent reductions. So project-based is generally affordable housing, which is encouraged through tax credits when there's new building, and basically it rents a particular apartment at a lower than market rate for low-income adults. And that low rent is tied to that apartment. So if the person moves out, the next person who moves in has to qualify and meets and gets that rent. That's separate from Section 8 housing vouchers, which are portable, where you can use at any apartment, if you can get one, and rent an apartment that is at or below the median apartment in your area, apartment rent in your area, and the federal government will subsidize that rent based on your income. In general, the vouchers, if you have a housing voucher, your rent is limited to, your individual rent that you pay is limited to 30% of your adjusted grossly monthly income. So if you work, a third of your working on a monthly basis might increase your rent that you're paying on a Section 8 housing voucher. And that needs to be looked at because, again, these benefits are not terribly well coordinated. In fact, they're not coordinated at all. And each one has a different rule. So if you're receiving reduced cost rent because you're disabled and you are low income, as your earned income starts to increase, you may also see your rent increase as well. Let's go on to the next slide. So we've covered, which in some ways are some of the more simpler rules. Well, we just covered all the means-tested benefits and how they're affected by work. We're now going to discuss some non-means-tested benefits that some disabled individuals may get access to. The first of which is Social Security disability income. Next slide. Of course, one of the challenges with benefits is that they sound alike. SSI and SSDI sound alike and are both administered by the Social Security Administration, but they're very different benefits. SSDI is a social insurance program for people who are disabled who can glom onto a work record, of someone who has worked and paid their FICA taxes into Social Security. SSDI is funded from the Social Security Trust Fund, and it's based on a wage earner's work record. Generally, and you probably remember this, if you ever heard anything about Social Security, you have to work for 10 years or 40 quarters of work in order to be fully vested into Social Security. However, if you're young enough, you need less quarters, and we'll talk about that for your kids. Now, SSDI essentially provides Social Security early before your full retirement age. But unlike SSI, it's not based on financial need. You could have $10 million in the bank, and if you're qualified for SSDI, you'll get that. It's not based on financial need. And SSDI is not reduced by working in some circumstances, which we'll go through. More importantly, one of the reasons why SSDI is so important for many young people is that if you receive SSDI for 24 months, you also get access to Medicare. Medicare and Medicaid are different health insurance programs, and you can be on both. This is one of the questions that was asked earlier. Can you be on both Medicare and Medicaid? And the answer is yes, if you meet the qualification for each one. So let's talk about how you might get SSDI. Well, there's two main ways: your own work record and potentially a parent's work record. And we'll talk about both those. Let's go to the next slide. So one important thing in talking about SSDI is considered unearned income for SSI purposes. And so generally, if there's no free lunch, if you're receiving SSDI and the SSDI award is more than $943 in 2024, it's going to completely wipe out the SSI. In most states, this is not true in Connecticut, if you're receiving at least $1 of SSI, you automatically get Medicaid. In other states like New York, people are concerned that if the SSDI wipes out their SSI, their Medicaid might be in jeopardy. There's a special rule for that. It's called a Pickle Amendment, and it exempts, allows those people to keep their Medicaid. Here in Connecticut, it's much more complicated. If the SSDI drives income above the income limit that's allowed for Medicaid based on whichever waiver program you're on, and you're not on MedConnect, then you may have to do something called a Medicaid spend down, which is more complicated than I want to go into in this particular workshop. But if you get a notification from DSS that the income is too high because of an SSDI payment, even if your child is not working, there are fixes for that. Let's go on to the next slide. So let's talk about first how you qualify for an SSDI benefit on your own work record. Well, the answer here is, and sorry, I'm going to, I've got some next year's numbers that I just want to mention to folks. So if you're younger than 30, you don't need to work for 10 years before you get access to SSDI. Now, here's how it works. If you make $1,730 in a year, then you earn 1 credit towards Social Security for that calendar year. If you earn 4 times that, or in 2024, $6,920, you get 4 credits towards Social Security. If you earn more than that in a year, you can't get more credits for that year. Your credits are just worth more. So, and the way that Social Security works with disability is after the age, from 21, if under the age of 24, you get 6 work credits because of how you worked, you are deemed to be disabled, you start to get a small SSDI benefit off of that work record. Every year after that, if that's when you became disabled, you need to work about half the time or get 2 more credits. So if you're 27 and you've earned 12 credits towards your Social Security, you're now eligible for an SSDI benefit. Social Security is tracking this for you. It means that if your kids earn about $7,000 for about 3 or 4 or 5 years in their 20s, they may start to get an SSDI benefit. That can be important because remember, for the most part, SSDI is not reduced when you work, unlike SSI. And it starts triggering the 2-year clock for Medicare. Let's go on. Now, just so you know, the work credit is going up by $90 next year. and next year you get a work credit if you earn $1,810. Now, the second way our kids can get access to Social Security, disability income, is something called the Childhood Disability Benefit, sometimes referred to as the Disabled Adult Child Benefit. And here's the concept. Social Security, this is why private accounts for Social Security will not work. Social Security is not a savings plan. It's a social insurance plan. So there are ancillary benefits for some people to collect even if they didn't work. The most common ancillary benefit is a spousal benefit. Most of you know when Social Security started in the 30s, dad worked and mom stayed home. Dad got a full Social Security benefit. Mom got a spousal benefit equal to half of what dad got when dad collected Social Security. And then when dad died, because in the 30s, dad always died first, mom got a widow's benefit of 100% of dad's benefit. Well, built into Social Security is an ancillary benefit called the Childhood Disability Benefit. And if a child was continually disabled since before the age of 22, I put disabled in quotation marks because it's not that they have a disability, it's that they're disabled according to that definition I mentioned earlier. If they're permanently disabled, continually disabled from before the age of 22 until the parent collects their own Social Security benefit due to death, disability, or hitting their retirement age, that triggers a childhood disability benefit for the child, equal to 50% of the parent's record while the parent is alive and 75% of the parent's primary insurance amount after the parent's death. What is the primary insurance amount? That is the amount that you collect at your full retirement age. If you're like me and you're born after 1960, your full retirement age is 67. And your child's childhood disability benefit is based on the amount you would receive at 67, whether you collect early at 62 and you get a reduction, or whether you collect at 70 and you get a bonus. They only get the amount based on your primary insurance amount, but they get that when you collect. And so this may impact families' claiming strategies for Social Security, because you may want to claim a Social Security benefit early, possibly, to trigger this for your child if that's important for your overall planning. Now, there are some family maximums. So if let's say mom was the primary wage earner, if mom's collecting 100% of her Social Security and dad's getting a 50% spousal benefit and child's getting a 50% spousal benefit, 100 plus 50 plus 50 is 200%. That's too much. Social Security generally has about a maximum of about 180% that any family can collect off of one wage earner's record. But that's there. Someone asked, the parent can retire earlier than age 67. So it's not based on when the parent retires. When you can collect is based on when the parent wants to collect. An individual who's paid into Social Security can collect as early as 62. If they do that, though, they're going to get about a 30% reduction from their own Social Security benefits. So claiming strategies in trying to game this system can be complicated. And you should be working with a financial planner or to help figure out what claiming strategies can be best for your family. Let's go on to the next page. So let's assume that your child is going to be collecting SSDI, either off of their work record or your work record. I mentioned that generally SSDI is not reduced if you work, but some things may happen. So SSDI was not designed for our kids. SSDI was designed for the Metro North worker who hurt their back, had to go on disability, and is now trying to get back into the workforce. These things were generally designed for physical disabilities, people who are able-bodied became physically disabled and are either through an accident or a health issue and are now trying to get back to work. So when you're on SSDI, there's this wacky system about what happens when you work. And so when you start working when you're on SSDI, you're automatically in something called a trial work period. And that means that Social Security is trying to determine if you can actually work on a regular basis. So they let you try work. That's why they call it a trial work period. And the trial work period starts the first month you work. And a trial work period is a rolling 60-month period. And while you're in this trial work period, there's no reduction for SSDI for earned income. And if you earn under, in 2024, $1,110, that's going up to $1,160 in January. If you earn under that trial work month, the month doesn't count and you get to keep all of your SSDI. However, if you earn over the trial work month amount, in the trial work period, you still get to keep all your SSDI. However, once you have 9 random trial work months, they don't have to be in a row, during a trial work period, Social Security says, you know what, maybe you can work. Because remember, you're only disabled if you can't consistently earn over that substantial gainful activity amount. So once you have 9 trial work months, you exit the trial work period and enter the extended period of eligibility, which is another 3-year period where Social Security is trying to determine, do they think that you can maintain that substantial gainful activity? During the extended period of eligibility, that 3-year period, if you earn under 1550, you keep all your SSDI. But if during that period you earn over the 1550, you get no SSDI for that month. And that goes on for 3 years. Let's go to the next slide. At the end of that 3-year period, Social Security is going to try to figure out, do they think you're capable of working at a consistent basis above the 1550? And they're going to determine, are you disabled or are you not disabled? However, after that 36-month period, if you actually earn over the 1550, that is proof to Social Security that you can work, and they're going to cut off the SSDI benefit. But you can get it back. So first there is this expedited reinstatement of benefits period, which if you're qualifying under your own benefit record, it's 5 years. If you're qualifying under a parent record, it's 7 years. And it allows you to reinstate the SSDI benefits without a whole new application, just by reaching out to Social Security and saying, hey, I can't work anymore because of my disability. You have to proactively apply for it. Social Security will not know that you're not working. However, if you go at the end of the extended period of eligibility, that 3-year period, if you go for 2 years without any income above the SGA level, you go back to the beginning and you start with a new trial work period, and it all starts from scratch. Let's go to the next slide. So there is one wrinkle with this that you have to be careful of for your kids if they're working too much, and their childhood disability benefit hasn't been triggered yet. So there's a flaw in the law. If you had childhood disability benefits because it was triggered by a parent collecting, and your child lost their disability qualification, they can get it back within 7 years and go back on mom or dad's work record. However, if they're deemed to be not disabled prior to mom and dad triggering the childhood disability benefit, they can never get access to mom and dad's record. Why is that important? Well, if you're a good worker, we're here in Connecticut, people make money. The maximum Social Security benefit that you can get at full retirement age this year is around $4,000. That means the childhood disability benefit is about $2,000. That's going to be a larger benefit than your child is probably going to get off their own work record. So if they ever were deemed to be not disabled because they're making about 20 grand a year, they may lose forever access to their parents' work record. Someone did ask, I just want to address this. Am I saying that the disabled parent that the parent collecting Social Security, that if the parent collects at 62 to trigger the childhood disability benefit for the child, the parent will decrease their benefit amount by 30%? That is correct. If you as the parent take your Social Security benefit early, there's a reduction for each month you take it before your full retirement age. For those like me born after 1960, if your full retirement age is age 67, if you take it at the earliest time, your individual Social Security benefit will be reduced by about 30%. However, you taking your Social Security benefit early will not reduce the child's childhood disability benefit. Let me give you an example. Let's say the parent had maxed out Social Security and their Social Security benefit at full retirement age at 67 would be $4,000. If the parent decided to take the childhood disability benefit at 62, their individual benefit would be reduced by 30% or down to about $2,800. However, the child would still be eligible for 50% of dad's regular benefit, or the child would get $2,000. Whether that's right for your family is based on a variety of factors and has to be calculated for you based on your individual situation. Let's go on to the next slide. So I wish I could take credit for this. This was developed by a friend of mine down in West Virginia. It may be helpful for your planning, especially for those of you who have higher functioning individuals, to keep a calendar of how much your child earns. Now, keep in mind, weirdly enough, unlike SSI, for SSDI purposes, income counts when you work, not when you get paid. So it works a little different for SSDI, but you may want to keep track on a month-by-month basis what you're earning, so you understand if you're going to be running into a problem with losing benefits. Let's go on to the next slide. Finally, if you're on SSDI, unlike SSI, technically you're not required to report income monthly. You're just supposed to report it promptly, which is at least every 2 years. But you can't go wrong with reporting monthly if you're on SSDI, especially if you're earning those trial work months. It will help Social Security figure out when you exit that trial work period. The methods for reporting income for SSDI are a little different. You can't use the SSI helpline or the SSI app. You have to either use the My Social Security website or sending a letter to your Social Security office. You are required, as with SSI, you are required to report when you start and stop a job. You may also want to get a letter from your employer, and you have to let your state Medicaid agency know. Let's go on to the next slide. So now we're going to talk about Medicare. Go to the next slide. And essentially, as I mentioned, individuals, once they receive SSDI, get Medicare after 24 months. However, Medicare does not necessarily end when you're no longer disabled. Essentially, Medicare will continue for 7 years and 9 months. Don't ask me where that came from. After the end of the trial work period, even if SSDI is discontinued. So they do let you keep the Medicare, the dual qualification, for more time because they realize as people are getting back into the workforce, they're not always can find a job where there's medical insurance. Let's go on to the next slide. I know we're hitting about 8 o'clock. I'm going to try to go through these things. We're going to go through these slides a little quicker. There are separate rules for individuals who are self-employed. Those are folks starting their own business. I hear a lot of talk sometimes about people with in agencies selling artwork or doing things as their own business. The rules are a little different. Essentially, any work on a 1099 basis is considered, or starting a business is considered self-employment for benefits purposes. There are certain exceptions, and so you can have a business bank account if you're starting a business as a disabled person, and that bank account and the inventory are not considered resources for SSI and Medicaid purposes. Generally, it's been recommended that a sole proprietorship or partnership structure is best for starting a business. If you have a C Corp or an S Corp or an LLC, that stock is counted as a resource. So it's generally not recommended. You are required to tell Social Security you're starting a business, and you might want to choose the right accounting method. If you're on SSDI, you're required to use accrual accounting, but if you're on SSI, generally cash accounting works better. Don't ask me what those mean. If you're starting a business as a disabled individual, hire an accountant. Next slide. So how does Social Security calculate? Because it's essentially when you start a business, you're going to be required to tell Social Security how much money you think you're going to make. They're going to take that income for the year, divide it by the number of months left in the years, and say, okay, well, you're starting a business July 1, there's 6 months left in the year, you think you're going to make $6,000, great, you're making $1,000 a month. And that's how they'll work your SSI. They deduct a little bit for self-employment tax. At the end of the year, you then tell Social Security what you actually made, and they will reconcile those numbers and either give you back money or take away money from your SSI based on how much money you actually made. Let's go to the next slide. As a self-employed individual, there are certain deductions that you can make to make the earned income count less. And so they can deduct something called unincurred business expenses. So if the state is providing a job coach for you for your self-employed business, even though you're not paying for it, you can deduct the value of that from your income so it counts less against SSI. By the way, you can't deduct that. You still have to pay IRS income. This is just how Social Security looks at the income. One of the wacky things about benefits planning is that different agencies count income differently. This is just for Social Security. In addition, there are certain things called impairment-related work expenses, which are certain things that you have to pay for because you're disabled to help you work. Someone said if a young adult is working under the income limits and on SSDI and Medicare, can they still switch Husky C to MedConnect and maintain DDS waiver services? The answer is yes. So MedConnect is only for kids who work. If they work and they switch to MedConnect, because of the higher income limits and asset limits, they may be able to maintain their DDS waiver services. That's the whole purpose of MedConnect. Let's go to the next slide. So some best practices for self-employed people: use a separate bank account, deposit all income attributable to the business into that account. Because remember, that account is an exempt asset. And owner's draw, taking money out of the business account, usually is not income for SSI and SSDI purposes because it's already been accounted for in the net profits calculation. But if you take money out of the business account and put it in your personal account, it will be a resource at the end of the month. One last thing. if you're on SSDI and you start a business and you tell Social Security you're working more than 80 hours a month, regardless of how much net income you're making, that'll count as a trial work month. So be careful about that if you're starting your own business. Let's go to the next slides. So finally, let's talk about strategies that you can use to minimize the effects of working on benefits and services. Next slide. So the first is the student earned income exemption. So if you're under 22, 21 or under, and regularly attending school, which means that you're in a college university for at least 8 hours a week, or in grades 7 to 12 for at least 12 hours a week, or in a transition program, even if it's summer and you're not there, there's a student earned income exemption to SSI. What does that mean? If you're a student and you work, yes, you are required to report the earnings to Social Security, but you will not see a reduction in your SSI as long as you're making under $2,290. That's important. You're in a transition program, a lot of kids work, a lot of kids get paid. Your SSI should not be reduced. Just remind Social Security you're still a full-time student. Next slide. Managing a paycheck. So I mentioned when you're on SSI, this is also true for SNAP, wages count when paid rather than earned. So if you're paid bi-weekly, there are 26 paychecks during the year. That means that in 10 months, you get 2 paychecks. In the other 2 months, you get 3 paychecks. You may want to manage those months when you get 3 paychecks to make sure you don't go over the limits for SSI and seem like you work too much. For SSDI, wages count when earned rather than when you get the paycheck. And so you may have to calculate your earnings for the month. You do want to watch overtime and holiday hours. So a lot of kids with disabilities work retail. What happens in November and December? Retail gets busy and they want you to work more, which a lot of kids are happy to do. Well, if you have 2 months during the year where you're working over the SSDI limit, you're working over that trial work month period. Well, you have 2 months over 5 years, that's 10 months. You may accidentally exit the trial work period. You want to be careful about how much you work, again, depending on which program you're on and what's going on. Let's go to the next slide. So briefly, impairment-related work expenses are expenses you incur because of your job, because of your disability. So if you are working and you have to buy a uniform, because everyone has to buy a uniform, that's not an impairment-related work expense. But if because of your disability you can't drive and you have to take an Uber to get to work, that could be an impairment-related work expense because it's something extra you have to do that someone else wouldn't have to do because of your disability. And essentially, if you collect impairment-related work expenses and you tell Social Security about it, that can reduce your countable income. So let's say you're making $1,200 a month and you're in a trial work period and you have $200 of Uber costs to get back and forth to your job. If that is approved as an impairment-related work expense, that reduces your countable income from $1,100 down to $900. And that could be helpful in meeting these requirements. You do have to keep the receipts and submit them to Social Security every month. And before relying on an impairment-related work expense, clear it with Social Security. Next slide. There's also a couple of other ways to reduce countable income, I highly recommend going to the Disability Benefits at Works and the SSDI toolkit at ssdi.disabilitybenefitsatwork.org. They have some great examples. So there's another example to reduce countable income called the employer subsidy. And if you can get an employer to agree that you as a disabled individual are only 80% as effective as a neurotypical adult, even though you're paid the same, you can claim that only 80% of your income should count towards all the income limits and reductions. Now, there is some work with this. The employer has to fill out a form. They have to renew it every year, but it can be a way to reduce countable income. There's also something called special conditions, where on-site job coaching may reduce countable wages. And sometimes paid time off during the extended period of eligibility, that 3-year period, does not count as earnings. Let's go on to the next slide. And finally, ABLE accounts can also help. Now, ABLE accounts can't help with the income. So let me repeat that. ABLE accounts can't help with the income rules. It can help with the asset rules. So one of the challenges many people have when they're working, disabled disabilities have when they're working, is they can't spend their money fast enough. Because not only getting the SSI or SSDI, but they're getting wages as well. Well, an ABLE account, and I have a whole workshop on ABLE accounts if that's helpful. Money transferred to an ABLE account does not interfere with Medicaid and SSI, and money placed in an ABLE account does not count as a resource for SSI and Medicaid purposes. Generally, you can only put in $18,000 a year. That's going up to $19,000 a year next year into an ABLE account. But individuals who work can put more money on top of the $18,000. They can put wages up to the federal poverty level of the prior year. So for 2024, they can put in $14,580, which was the poverty level for last year, into an ABLE account of their own work money on top of the $18,000 either can go into an ABLE in general. It can be a great resource to shield assets so that you're not over whatever asset limit you need to maintain the benefits that you're on. Next slide. I think that's the end. I want to thank everyone for lasting and staying with me through all of this. I do offer a complimentary 15-minute call for folks. I know that you'll be getting an email from CPAC after this.
Yes.
But if folks want to reach out, I do these workshops on a regular basis. You can see the timing for them. I'll be running a series of workshops starting in January, probably in mid-January, on these and other topics. You can see that information on my website, or after this, you can send me an email and I can add you to the mailing list. CPAC has asked that I not reach out directly to individuals who have attended unless they first reach out to me. That's what I got for today.
Thank you.
Questions?
While we're doing questions, I'm just going to launch a poll. If everybody can answer, we appreciate the feedback. Any questions?
You know, this stuff is complicated. And, you know, although I will tell you that for each of you, it'll be less complicated when you concentrate on the mix of benefits and services that your child has and how the work affects there. There was a question, talk about dual eligibility versus Husky C. So, you know, one of the challenges with benefits is you get eligibility based on different things. So if you are disabled and financially needy, meaning that you have low income and assets under $1,600, you are eligible for Husky C as in Charlie, which is one of the 4 flavors of Medicaid that we have here in Connecticut. And that, remember, Husky C covers health insurance and funding for benefits and services. And that's the eligibility for Husky C. For Medicare, you are eligible for Medicare if either A, you've paid your FICA taxes and made it to 65, or you're receiving a Social Security disability income benefit, including that childhood disability benefit, which is SSDI off a parent's work record. So if you're disabled and a parent collects their Social Security, if the child had been permanently disabled since before the age of 22, and they're deemed to be disabled by Social Security, they're going to get Medicare 2 years after you collect. At that point, if they're still maintaining their Medicaid eligibility, that child will be what's called duly qualified. They'll be on both Medicare and Husky C. For health insurance purposes, when you're on both Medicare and Medicaid, Medicare will be considered primary as your health insurance, and Medicaid will be secondary. You can only be duly qualified with Husky C. Husky D, which is just for low-income adults, you're ineligible for Husky D if you're on Medicare. Because, again, Husky D is not for people who are deemed disabled. Someone did ask, how much is the maximum for an ABLE account? How much do you need to open an ABLE account? So, ABLE accounts can be a little complicated, but you can open an ABLE account in most states, in most plans, with as little as $25. And in general, ABLE accounts, money in an ABLE account are not considered a resource for SSI and Medicaid purposes. However, once an ABLE account reaches $100,000, amounts above that are considered a resource for SSI purposes. So if you have an ABLE account with $101,000, the last $1,000 of that will count as a resource for SSI. And if that plus their bank accounts put them over $2,000, SSI will be cut off. On the other hand, an ABLE account is never an asset for Medicaid purposes. Someone had asked, doesn't a spend down come into play if they're over income? So this person is asking about Medicaid. So when you're on Husky C, you can only have limited income and still qualify for Husky C. Now, I wish I had a better answer than this, but I can't tell you how much income is too much income for Husky C, because it depends on whether the income is earned income, like working, whether it's unearned income, like SSI or SSDI, and if you're on a Medicaid waiver program, because all of those impact how income affects Medicaid. In addition, with all those things, if you're working and on MedConnect and switch your Husky from Husky C to MedConnect, you probably will not need an income spend down to keep getting your Medicaid services. However, if your child is not working and they are, so the situation would be this. Let's say a parent dies, they had maxed out Social Security, and therefore the childhood disability benefit after the parent dies of 3/4 of their benefit equals $3,000. Because $4,000 is the maximum SS Social Security, 3/4 of that is $3,000. If the individual is not working, that $3,000 is probably going to put that individual over the Husky C income limit. If that is the case, there is an income spend down that is available. It gets complicated. You have to open up an account with an organization called Plan of Connecticut through their pooled trust, have excess income sent over them on a monthly basis. That account can then be used for child for certain resources. It's very, very complicated. If you're in that situation, you should speak to an expert at DSS if you get a hold of them, or if you're affiliated with a DDS agency, because there's an intellectual disability, that agency can probably help you coordinate the Medicaid spend down. Again, I wish I had a better answer, but if that's your situation, there are resources to help you figure out how to set up the income spend down to maintain your Medicaid. I wish DSS was more helpful. As many of you know, trying to reach DSS by phone can be challenging as a consumer. That's why I recommend either working through a DDS agency if you're so affiliated, or go down to one of the, I think there's 9 separate DSS offices that have walk-in hours during the week. Go there and say, help me. And they will help you figure out what you need to do for the Medicaid spend down.